from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the volatility continues for big tech. Are there more sell-offs to come? Plus, Jamie Dimon doubles down, saying if you don't get vaccinated and you don't come into the office, you don't get paid. This as companies like Meta continue to push back the big RTO. We'll bring you a virus update. And could the Bitcoin Deathcross be upon us? What, you ask, and how bad would it be? We'll talk about that and more with the president of the blockchain startup, Ava Labs. All of that in a moment, but first let's get a look at the markets with our own Ed Ludlow. And Ed, stock selling off early but staging a comeback. What happened?
Yeah, finally some green on the screen after 5 straight days of decline on the S&P 500, of course, the main gauge of US equities. That recovery in tech stocks started Monday, right, with the NASDAQ 100 closing up marginally, a much bigger outperformance on Tuesday, up 1.5%, and that kind of rebound carrying through into semiconductor stocks as well. You see there on the Philadelphia Semiconductor Index up 1.8%. Bitcoin, we're back above 42,000, Emily, almost at 43,000. So that is a recovery in terms of what we've seen in recent days. We'll come on to that later in the show. Come with me into my Bloomberg terminal. We've got to talk about what the driver of the markets was today. Fed Chair Powell saying in testimony that he essentially reassured investors, right, that the Fed is going to act to stamp out inflation as the economy is rebounding. And he signals that in terms of accommodative policy, the Fed will start to shrink the balance sheet in 2022. You see those risk assets there, Bitcoin, the ARK Innovation ETF, the NASDAQ 100, all making gains following those comments by Powell. Big upward tick there. In terms of the specific movers, there are big company names that are seeing some love as well. I want to focus in on the mega caps like Apple and Amazon, both big movers on Wednesday. Meta Platforms also up almost 2% on the day. We've got breaking news, of course, after the bell about a new board director, which we'll cover later in the show. If there's one mover to the downside, it was IBM, down 1.6%, having its price cut at UBS from $136 to $124. They cut their recommendation to sell from neutral. They're basically saying IBM's overvalued, guys, and that the stock could be in trouble over the next 12 months. Finally, just let me finish on this one, Emily. I got a little gift for you. I like to do that sometimes. You know, a brand new index, the Bloomberg Grayscale Future of Finance Index. This is really cool. It's a basket of 21 companies, 22 companies that are related to the future of finance, blockchain technology, cryptocurrencies. You can see they've had a torrid time the start of this year as we've seen the sell-off in cryptocurrencies, but they staged a comeback Tuesday along with cryptocurrencies and had their best day since December 23rd. So don't say I don't give you anything. A brand new index so you can see the link between cryptocurrencies and those crypto-related stocks in equity markets.
And you are so generous. Thank you for that gift. Appreciate it. I want to stick with the volatility we're seeing with tech stocks and welcome Michael Casper, equity strategist with Bloomberg Intelligence. Look, Michael, how much is what's happening with tech right now? How much does it have to do with tech? And how much does it have to do with rates?
Well, quite a bit of it has to do with rates. Tech, based on duration, which is a bond concept we're applying to equities, is one of the higher duration sectors in the S&P 500. So what duration measures is the time it takes for cash flows to pay off your initial investment. And the longer that time period, the more interest rate sensitive a sector or a stock can be considered. And we've seen this play out since the December 3rd Treasury yield bottom. You know, it surged quite a bit since then. And tech has been one of the worst performers since that point in time, since that bottom. Whereas financials on the other end, which is one of the lower duration sectors, has been one of the better performers in the S&P 500.
We've got tech earnings coming up. What impact do you think that will have?
I think tech earnings could do a bit to calm some fears within the market. Right now, some of the tech stocks, especially Magma, are expected to lag the rest of the index through the year end. So some positive news could help settle some of those fears, at least in the coming weeks.
So let's talk about then what you see ahead. If valuations are stretched, what does that mean?
So valuations are definitely stretched, and valuations, I always tell clients, aren't necessarily a catalyst to sell or buy any investment. Of course, you've got to have growth behind it. But the real issue, I think, behind tech and a lot of the tech stocks, like I mentioned, Magma, which are, of course, the 5 biggest tech-related stocks: Microsoft, Apple, Amazon, Google, and Meta Platforms. A lot of the issue behind that is that the EPS growth for these companies, and tech in particular, is expected to lag the rest of the index for a considerable amount of time. So right now, the tech premium sits at about 1.5 standard deviations above its 5-year average. Even excluding Apple and Microsoft, 2 of the biggest names in the sector, it's 1.4 standard deviations above average. And the real catalyst for that coming down is some of that EPS lag between those companies and the S&P 500. And eventually, these stocks could get back to more reasonable valuations, or have their EPS across the upside, and then valuations do kind of maintain that level.
I want to hone in on Apple and Microsoft there. Do they, to you, appear overvalued, or are they a bargain?
Right now, based on some of the metrics, like we use WatchGo on the terminal, it would suggest that the companies, based on their own history, are somewhat overvalued, at least on a forward PE basis. But again, that's all going to depend on how EPS materializes, and if it materializes more in line with consensus, or some of those more optimistic projections.
What parts of the tech sector do look discounted to you?
Yeah, so right now, IT services is the only industry that is discounted to its 5-year average. Some of the other industries like semis, software are sitting more in the middle, trading right around average, a little bit above, but nothing too crazy. Whereas on the other end, the equipment, comm equipment and electronic equipment are definitely expensive, and they're trading more than 1 standard deviation above norms.
All right, lots to continue to follow, especially with earnings season about to get underway. Bloomberg Intelligence's Michael Casper. Michael, thank you for sharing your insights with us. Meantime, other news we are watching this hour, Meta has a new board member. DoorDash CEO Tony Xu is joining Meta's board of directors. That means advising Mark Zuckerberg. Xu's appointment effective immediately. This brings the board to 10 members, including Zuckerberg and Sheryl Sandberg. Meta has made a big push in recent years to become a bigger force in e-commerce and a bigger resource for local merchants via both Facebook and Instagram. Coming up, as the Omicron variant spreads, companies continue to crack down on mandates. We'll discuss the overall RTO picture next. This is Bloomberg. JP Morgan CEO Jamie Dimon has issued a warning to the bank's unvaccinated workers in New York. If they don't get vaccinated, he told CNBC, they won't be allowed in the office. And if they're not at the office, they're not going to get paid, says Dimon. Let's get some of the latest RTO news with Bloomberg's Kara Wetzel. Kara, good to have you back with us. We're waiting for the Supreme Court now to weigh in on Biden's shot or test mandate. How are companies dealing with this in the meantime?
Well, companies are having to figure it out on their own, as they have been, and recognizing that, more guidance might be coming from the government, maybe not, depending on how the Supreme Court rules. But especially as Omicron surging, taking the steps to perhaps get a little stricter on their vaccine rules without coming out and outright declaring a mandate that might, put off some workers, especially at a time of tight labor market. So you have JP Morgan's Dimon, who said in an interview yesterday that his firm is taking things, case by case, location by location. At the same time, Dimon is a big fan of offices, particularly in New York, and is telling New York bankers that they have to get vaccinated to come into the office, and if you don't come into the office, you might not get paid. So basically a mandate without so much saying as much. And, over here in the Bay Area and in Techland, you have Meta coming out and saying that you have to have a booster to come into offices, and delaying their office return until late March. So it kind of continues to be Royals and companies continuing to take their own stance in terms of the rules for employees.
And we're seeing somewhat of a divergence between Wall Street and Silicon Valley there. We are seeing glimmers of optimism with Omicron. New York City potentially hitting its peak. At the same time, we're hitting new records for infections in California. What are the numbers telling us?
Right. So in New York, you have Governor Kathy Hochul saying that it appears there's been a plateau there. New York, of course, was one of the earliest places in the U.S. to really get hit hard by the Omicron surge. You saw that start to play out before Christmas, and it's sort of petering out across the rest of the country. So, it's a hopeful sign that New York is starting to potentially be on the upswing. Again, very early to say. At the same time, as you mentioned, California, more than 140,000 cases recorded today, which is the highest numbers of the entire pandemic, and similar things happening across the country. So while there is hope that perhaps this will start to slow down eventually, we're kind of in the thick of it across the country.
So what are we watching for next? When do we get a signal from the Supreme Court?
Any day, any hour. The rules that were from the Biden administration technically were supposed to go into effect yesterday from OSHA, and OSHA has said it won't really enforce them until February, given all the legal questions. But this really, could come down. Legal experts had expected the court to wait pretty quickly, given the timeliness of the situation. So we're watching out for that.
All right, Bloomberg's Kara Wetzel, thank you for that update. I want to stick with the return or not to the office theme. Workplace tech company Envoy is helping to transform modern workspaces into safe spaces to connect and collaborate in a hybrid world. The company just announced new funding, $111 million. I want to bring in CEO Larry Gadea now. So Larry, talk to us about your technology. I know it's not just hot desking, but this is certainly the new trend. How does it work?
Yeah, absolutely. And thanks for having me. So generally, here's what's going on. It's complicated, right? The rules keep on changing. You need to keep track of vaccines, of boosters, of testing results. Some people should do testing, some should do boosters, some should do vaccines. It's very complicated for people and for the companies. And really what's important is you make it easy for everyone. There's enough stresses going on in the day-to-day, and really we're building software to make that really easy and think of how do we bring this into the future, and how do we bring the workplace to be a place that people kind of want to be in and are excited about.
How would you describe the demand for hot desking and the services that you offer, and how that has evolved over the course of the pandemic, especially right now that we're in this messy middle where vaccines, boosters are available, but infections are peaking and return to work dates continue to get pushed back?
Yeah, I mean, it's really complicated, right? You don't know who's going to be in and who's not. Are these teams going to be in? Are these teams not? And this is the whole thing. But people do want to go back because there's a sense of community that's really important for companies as they retain their people. So hot desking is a clear example of something where, hey, you're coming in, you say you're coming in with a group of people, and it will put you all together near a meeting room, and it will book that meeting room for you. It's that thoughtfulness that's more and more important, because people aren't at their desk 5 days a week anymore, at least in a lot of companies. So for those companies that maybe even hired more people than actually used to be there, and it's kind of like you can't fit everybody there. So you need to be a lot more thoughtful about all the logistical pieces going on in offices. We're doing our best to make that easy.
You just raised some new money. Where does this funding go towards? How do you plan to grow and evolve?
Yeah, absolutely. It's a lot of money, but it's also we're only getting started with the things that we're building for workplaces. We've been at this for a little while. People know us for this visitors product, but it's really, that's just the beginning, like desking and rooms and having a mobile app where people can see each other and can learn about each other. You don't know who's sitting near you these days, and beyond. Like it's about the safety, and it's about making the community happen again, despite all of the pandemic and despite all the things going on. Companies need more community, and they need people to kind of see the value in each other. And that's really what we're trying our best to help companies with.
Curious, are you sitting at a hot desk right now? I mean, is that what the future of work looks like? What's behind you?
That's basically it. There is a sofa area behind me, but this is a desk like any other, and it's important that I did book it, and hopefully somebody else won't have it in the next couple hours. It's just like a meeting room, but it needs to know, right? And you can get so many more analytics in a company to know which desks are used more often, who's sitting next to who, which teams collaborate more. So the data in the workplace is going to just let companies and people just know more about each other and create a great environment.
What's the growth outlook? Yes, hybrid work is here to stay, but as the world starts to reopen and stops closing after reopening, doesn't that mean your growth plateaus or drops?
Here's the thing, if we've learned anything, it's that it just there's Delta, there's Omicron, there's some new version that combines them. I don't even know these days, But what's important is that we keep on iterating, we keep on building things, we keep on iterating with what's going on in the world. Like, if people are always going to need to get to know each other better and work better with each other, and that's really at the end of the day what we're trying to be really, really good at. And this is what our customers really believe in from us too. By investing in Envoy, by buying and using Envoy in your office, you're investing in the future of the workplace to be much more community oriented and something that's easy and thoughtful of the people inside.
Well, and that leads me to my next question, which, people have been saying San Francisco is dead, quieter than they've ever seen. Who's really going to be coming back to work?
No, it's a great question. Here's the thing. San Francisco is one piece of it, but there's essential workers all around the world, people that don't have a choice. There's warehouses, factories, pharma companies. They have equipment they got to be there for. They need to be safe too and thoughtful about their environment. But at the same time, the tech companies also are, hey, we want to bring people back. We need to give them great reason because we know that community is so important. And really, that's what we're seeing. That's what the investors are seeing. That's what the data is showing us from our own companies. And we want to just foster kind of people bringing people together in these workplaces.
All right. We shall see. Envoy CEO Larry Goodday, thanks for joining us from your hot desk itself. Hope you got it for the next couple of hours. Coming up. In the last year, California's population has declined. On that note, the state losing a congressional seat, and a number of high-profile companies, from Tesla to HP, have relocated. How will Governor Gavin Newsom plan to tackle these ongoing issues? We'll bring you the state's new plan next. This is Bloomberg. Dubbed the California Blueprint, Governor Gavin Newsom has proposed a $286 billion budget plan. California is home to the world's fifth largest economy and remains a leader in progressive causes like banning new gas-powered cars by 2035. Yet the state continues to lurch from crisis to crisis, including wildfires, crime, traffic jams at the ports, and now a surge in Omicron, despite some of the toughest virus mitigation policies in the country. Bloomberg's Romy Varghese joins us now to discuss. Romy, walk us through the state's new plan and how it will address these crises.
Thanks, Emily. Yes, luckily for the state, it has a lot of money that it can use to try to tackle these problems. And in the governor's budget that he presented yesterday, he outlined the 5 threats to California and what he plans to do about it. And he wants to spend billions of dollars, for instance, for wildfire mitigation, as you mentioned. And he also really wants to promote climate change technologies and promote things like electric vehicles, as well as address, of course, the homelessness and housing issues. And we're seeing that that he's really trying to continue to say that California is the center of innovation with some of these focuses on climate change.
What's been the impact from tech company departures like Tesla, HP, and beyond?
So far, while they have made a lot of headlines, so far they're not enough to move the needle for California. As you mentioned, it's the world's 5th largest economy. It accounts for $3 trillion. The state still expects corporation revenue to increase, on average 7% every year. So we're not quite seeing the impact on the bottom line. And the state is doing things to try to promote technology in the state. For instance, in this budget for the next year, the governor proposed something interesting, a new tax credit for companies headquartered in California that are developing new technologies to mitigate climate change. And I think that kind of shows, the focus for the governor at this point.
What are the main drivers of people leaving the state? Are they looking for a cheaper quality of life now that they can work from home potentially?
No, that's the exodus from the state has been a little bit misconstrued because, here in the San Francisco Bay Area, we have seen a lot of people leave, but they actually went to other parts of the state. And the reason that California's population dipped in 2020 was more due to the fact that we didn't see enough foreign immigration. And that's due to, of course, federal policy And what really dipped the population down was the deaths from COVID. So moving forward, it'll be interesting to see if any changes in immigration policy could change the way this trend is.
Wow, that is honestly that's tragic to hear it put that way. What can the state do to continue to attract people and business?
The state is trying to promote its tax incentives for businesses, and with this budget, the governor was trying to address some of these quality of life issues that we see every day. For instance, he is spending the most money ever on clearing encampments. He also has dedicated $2 billion to promote housing and easing homelessness. So there, and of course, when it comes to the state's education system, the per pupil spending is going to be the most in history. So the state is planning these investments that they hope will pay off in the long term.
All right, Bloomberg's Romy Varghese, thank you for that update. Well, February 4th, that is when the next union vote is set to begin at Amazon's Alabama warehouse in Bessemer. It'll be held by mail, but the voters won't be counted until almost 2 months later, March 28th. The union was voted down the first time around, but a federal labor board accused Amazon of violating a labor law, something Amazon denies. One of the biggest issues facing both sides is that the majority of those voting might not actually be there by the time the ballots are counted due to Amazon's exceedingly high turnover rate. And Kim Kardashian was sued for allegedly scamming investors in a cryptocurrency called Ethereum Max. The reality television star and other personalities were paid to hype the blockchain-based digital tokens to their fans, which the complaint says caused investors to purchase these losing investments at inflated prices. The scam is actually one that Ethereum co-founder Vitalik Buterin had already called out on Bloomberg Studio 1.0 several months ago. Take a listen.
The thing that I was unhappy with about Kim Kardashian was that she basically shielded something like Ethereum Max that was I'd call it a borderline scam, right? It seems like this project that's basically just at best a pure money grab that's not really providing much of value.
Coming up, we'll talk more about crypto sans scams. We're going to be joined by Ava Labs President John Wu to get his take on this year's trends in blockchain, DeFi, gaming, and where does Bitcoin go from here? That is next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. I want to get back to crypto with our Ed Ludlow and a worrying sign for those watching the charts. Ed, how worried should we be?
Well, look, no matter how you slice it or dice it, it's been a rough 7 days for Bitcoin holders, for crypto enthusiasts. This is performance over a week. The Bloomberg Galaxy Crypto Index, of course, is the majority Bitcoin and Ethereum and some other constituents. You know, we talked about how on Tuesday, Bitcoin popped back above $42,000. But cue ominous music, right? And come with me into my Bloomberg terminal. Look at this chart, the Deathcross. So when an asset class's 50-day moving average is heading down, that's the white line in the top panel in the case of Ethereum, the yellow line in the case of Bitcoin, towards its 200-day moving average and dipping below it, that is a bearish indicator. It's indicative that the asset class will continue to see further declines. What's been fascinating over the last 24 hours is we've talked so much about Deathcross, but different corners of the crypto community have put this into question because, yes, Bitcoin, which is the bottom panel, has had this Deathcross before. The yellow line, the 50-day moving average, has dropped below the 200-day moving average, the purple line, but it hasn't always resulted in further losses. In fact, on several occasions in recent years, investors have seen it as a buying opportunity, and we've seen a rebound in the cryptocurrency. One thing at the heart of this, as I read across all the analyst notes today, look on Twitter, what's trending, look at what the hodlers are saying, is what is Bitcoin? we're expecting it to behave like a traditional asset class. In many ways, it does behave like an equity. As equities have sold off with rates, with the outlook for higher rates, it too has sold off. But others treat it as a commodity because they're a finite amount. Others teach it as an emerging technology. So what is it? That's not for me to answer. But luckily, you got someone smart coming right up.
We do indeed. Thank you. I want to look ahead now to crypto in 2022, where we go after this rocky start. Joining me now, John Wu, president at the blockchain startup Ava Labs, a smart contracts platform that makes it easier to launch DeFi applications. John, great to have you back with us. So, is it Deathcross looming? Do you see more downward momentum or doom ahead?
Well, first of all, I would like to ask Ed, what's the opposite when the 50 or the 200-day crosses the 50? Because that happens a lot in this space as well. And he focused a lot on Bitcoin. Listen, I think this asset class, the surprising thing about this asset class is that it'll be one of the few asset classes that can withstand the macro headwinds, whether it's a hawkish Fed or anything else that happens geopolitically speaking. And the reason why is very simple. I mean, where I sit, I have a backstage pass, so to speak, as an operator, and the amount of inflow of talent, capital, and basic users is just astonishing. And that has not stopped. That has continued even with the short-term sell-off.
Well, and on that note, you've got a lot of investors invested this time with more capital than they've ever had before. Yes, there have been corrections before, but investors, mainstream investors, haven't had this much invested. Give us the mood of the investors out there and how they're feeling.
Yeah, I think the public investors have, obviously, they will be part of the broader market. When they see growth stocks that are down 50, 60%, they have the same visceral feeling when they see the crypto markets down that much. But the venture investors, and they raised about 100 billion plus last year, they're still allocating more and more of that 100 billion towards crypto projects. And those VCs, they're actually investing no longer just in the enablers like the Coinbases, the on-ramps, the infrastructure. They are looking at the core of crypto. They're looking at the layer ones. They're looking at specific DeFi dApps. So the asset class can grow even if Bitcoin loses market share. Bitcoin, in fact, is only 40% of crypto. It was about 65, 70% just about a year and a half ago.
Now, everyone's talking about the Fed and rates. We heard Jay Powell's testimony at his confirmation hearing today. What will be the influence, you think, of Fed policy on crypto this year?
So I do think in the short term, it will affect the public market participants and the retail investors. But ultimately, and I've seen this in every single tech cycle, smart money will follow the innovation. And the innovation is happening on Web3. That is where the talent is going. That is where the applications being developed is going. That's where the developers are going. And that's where there's a crazy amount of growing usage there. So the VCs and the longer term money, they will follow the innovation, and then they will be a nice buffer for the asset class, especially for the tokens and the companies that are creating utility.
All right, let's talk about regulation. Jesse Powell, the CEO of Kraken, on the show at the end of last year, had this to say about regulation to come. Take a quick listen.
We're not against regulation at all. We're licensed all over the world. Very happy to work with regulators. It's about clarity, though, for us. There's a lot of people sitting on the sidelines just because they're not sure about it, and the uncertainty has a chilling effect on banking and across the board.
What kind of regulation, John, are you preparing for this year?
So we are always fully compliant. Just like Jesse's company, Kraken, we are in the US, so we do everything by the book, so to speak. The regulation will come, and it's actually a good thing, just like Jesse said. No one here is against regulation. They just want clarity, as he said. If there's certainty and you can play by a clear set of rules, you will keep a lot of innovation and you will keep a lot of the volume of trading in the US. I mean, part of the reason why the tech markets are so good in the US is because it's the deepest capital markets, and it's an environment that allows for innovation. We want to keep that development here, and we want to create deep capital markets. Clarity and rules will allow that to happen.
Meantime, JP Morgan recently released a report talking about Ethereums Merge. I'm curious what you're seeing there so far and what Ava is bracing for, preparing for as that merge happens.
So I think that report, if I'm reading the same report that you talked about, they said a couple of things. One is that Ethereum's losing some market share to other layer ones like a Avalanche or other layer ones. It's also talked about bridging, correct? So I think the report had some good ideas in it. And I mean, if you think of all of these layer ones, all of these blockchains, it's kind of like they're all different cities with their specific characteristics of, based on the technology and the community that's there. And each of these blockchains are starting to develop for different purposes, and the community showing up are there for different purposes. And for Web3 to really flourish, one has to get from one blockchain to another easily. So the Avalanche bridge, for instance, from Ethereum to Avalanche, $32 billion already traveled back and forth on that bridge. A net 6 has stayed in Avalanche. You are not going to get the best of crypto 3.0 unless all of these blockchains in a multi-chain will be able to connect to each other, and users can move around and play with different tools and different applications.
Given that you just launched Avalanche Bridge, I'm curious, this is what allows you to transfer assets to and from Ethereum. How is blockchain interoperability going, and what are you learning?
I think it's just taking off, frankly. And what we're learning is there are different reasons for each blockchain to flourish in certain areas. And they're trading off technology for other technology, and then certain community goes there, others go to a different one, but they all want to try different things at different times. It's no different from the Williamsburg Bridge connecting Manhattan to Brooklyn. People want to try different food, try different things. What we're learning is there is a real appetite to move back and forth. And the bridge that I just cited from Avalanche, again, in 6 months, we've seen $32 billion of assets move back and forth. That is an astonishing number, given that, think about it, DeFi as an asset class is only 100 to 150 billion.
By the way, back to your earlier question, Ed saying a golden cross is the opposite of a death cross when the bullish indicator is what lies ahead. Curious what your thoughts are on trends that we'll see in 22, whether it is in crypto, NFTs, VCs, the crossover of crypto and gaming. What are you most excited about? Golden cross
we're
or
excited. Not? So a couple of trends within crypto, and I think the asset class will have a golden cross, by the way. But within the asset class, one of the things that we're really exciting, and you talked about regulation, is an institutional DeFi product. So as in the JP Morgan report cited the embracing of DeFi from various institutions, I think tokenization of financial assets, and then also creating a playground, so to speak, where DeFi is done in a very compliant way. You're going to see a DeFi for institutional product out there. I'm very excited about that. Also very excited to see what's going to happen in gaming. And the reason why gaming is so important is because it's kind of like the gateway for adoption. NFTs was a great gateway for adoption in 2021. DeFi was accruing value, but the individual adoption was happening more rapidly in NFT. In 2022, that's going to happen on gaming. Gaming is really the intersection, all the good things about NFTs, gameplay, as well as DeFi. Some of the games that we're seeing, the creativity that's happening and creating the gamification of playing and earning and using your own unique NFT, it's going to take things closer to, this is part of to like a metaverse environment. And I think that's part of the reason why even Web2 companies like, Facebook or Meta now is so interested in the metaverse.
All right, well, golden cross or death cross, we shall see. Thanks for sharing your predictions with us. John Wu, president at the blockchain startup Ava Labs. Thank you. Now, Twitter exploded recently when writer Cory Doctorow suggested that Norton LifeLock's latest antivirus software was, quote, sneakily mining crypto and charging users for it. Bloomberg's Alex Webb has more.
The antivirus software maker Norton LifeLock elicited a torrent of Twitter vitriol recently. The writer Cory Doctorow pointed out that its Norton 360 product included a feature dubbed Norton Crypto that mines cryptocurrency in the background on computers on which it's installed and charges users a commission. There was outrage, 11,000 retweets, 23,000 likes. But what's really going on here? What is Norton up to? This is indeed a feature of Norton 360, albeit only in the US for now and on computers that meet the minimum system requirements. It can mine the cryptocurrency Ethereum while your computer is idle, and Norton will take a 15% cut of any money you make. The uproar seems mostly to have stemmed from the fact that Norton had initially failed to point out that this was an opt-in feature. It won't mine any digital currency without the user's permission. It has since updated its FAQ page on the theme. But that doesn't mean that Norton Crypto is problem-free. There's a good chance that users could still make a loss from mining Ethereum using the system. That's because of two things: the energy consumption and what's known as the hashing power. Energy consumption can be really high because, as we know, mining cryptocurrencies is extremely energy intensive, even though Ethereum is more efficient than, say, Bitcoin. And the hashing power is a measure of how quickly a given computer can mine cryptocurrency. The problem is that we have no visibility into either for Norton Crypto. If the hashing power is low but the energy consumption is still quite high, it's distinctly possible that the 15% commission that Norton takes tips the user into a loss. I asked Norton for more detail on both these things based on the minimum specifications it stipulates, and it declined to comment beyond this statement, in which it basically says that this is an opt-in product. All in all, it's a bit of a mess. Another company trying to jump on the cryptocurrency bandwagon for sure, and maybe turning a quick buck while its users make a loss.
Bloomberg's Alex Webb there. Coming up, fundraising for VCs not slowing down anytime soon. We're going to look at where the money is going and what it means for the industry as a whole. Next, this is Bloomberg. Records were shattered in 2021 in the world of venture capital, and 2022 will likely be no different. We're already off to a hot start, but where is all the money going? I'm joined now by Bloomberg's Katie Roof. Katie, great to have you back with us. I want to start with Y Combinator announcing the amount of money they're putting into each and individual startups increasing to $500,000, up from $20,000 back in the day when it was Airbnb. Brian Chesky, the CEO, tweeting, "When we did YC, you got 20,000. Now you get 500,000. Is this good for founders or just YC?
Hey, good to be with you, Emily. Yeah, so certainly there's a debate in the VC community right now about this. Some think it's great news because if you're a first-time founder and you don't have a lot of money, and $500,000 will get you a lot further than $20,000, especially if that's your salary and your founder's salary. I mean, how long does that last? Right. So I think that, it will certainly help get some startups off the ground. But part of what comes with the territory of them investing more money is they also get more ownership stake. And already there were some gripes in the VC community that Y Combinator was owning a significant percentage of these companies for, basically discovering them. But now they'll own even more. So some people, agree with the decision and think it's good news, but others say, maybe this isn't the right move.
Meantime, Sequoia, long-time, very traditional Silicon Valley venture capital firm, as well as Paradigm, investing more than $1 billion in the ETF firm Citadel. This is a different kind of investment for Sequoia. Why are they doing this?
Yeah, this is certainly a surprise for a lot of people in the industry. Sequoia, obviously notable for its private investing. I mean, certainly they have held public stocks, companies after they go public, and they've gotten more into public investing recently. But this will kind of open up the door for a lot of different kinds of access to a lot of different kinds of deals for them. I mean, really, they're owning part of Citadel here, but through Citadel, it has its hands in a lot of different businesses, including Robinhood, which Sequoia is already an investor in. So some are wondering if that would somehow create a conflict of interest, hypothetically. But right now, this really shows that Sequoia is really thinking outside of the box here. They've said as much in recent months that they feel like the old model of venture capital is due for a change, and so they're really looking at different ways to invest in in the finance world. The changing finance world. And one other thing that's notable about this is Paradigm, which invests in crypto and Web3, as they say, is investing in Citadel. And they say that would mean Citadel would get into more crypto in the future, which is interesting because Ken Griffin, the owner, has had mixed sentiment about crypto in the past.
Interesting. And last quick question. Kleiner Perkins, another storied venture capital firm, launching 2 funds today. Andreessen Horowitz just raised a $9 billion fund. Are we going to see more of this?
I mean, it sounds like the LPs are happy right now, and they're giving venture firms more money. This is common. We've seen, every year we kind of see more and more money getting thrown into this ecosystem. I mean, certainly I would think, some of the top firms are providing such great returns that it's not hard for them to get more money when they ask for it. Sometimes, if anything, you have people itching to invest in these funds. So, but one thing that you do wonder about is valuations. People say have gotten pretty out of hand, and many people are increasingly saying that we're due for a correction, especially when you look at how the tech stocks are trading. And so, more money in the ecosystem drives up prices. So it'll be interesting to see how that works out this year.
Wow, the numbers are big. We know that. Bloomberg's Katie Roof, thank you. Coming up, 50 company stocks to watch in 2022, from Airbnb to Netflix and more unexpected stocks. The analysts at Bloomberg Intelligence are giving us their top picks for the year. More on that next. This is Bloomberg. Which company should you be looking at in 2022? I want to take a closer look at tech stocks with Bloomberg Businessweek's Joel Weber for this week's Big Take. And our analysts at Bloomberg Intelligence, Joel, have narrowed down, I believe, 2,000 companies to 50 stocks to watch. What stands out to you?
Well, there's a couple of big macro themes that inform the list. And to take 2,000 companies and whittle it down to 50, it takes this amazing team and spreadsheets and everything. They just kind of like push everything through until they come up with companies that are informed by themes. The transition to electric vehicles, the ambitions for the metaverse, China's regulatory crackdown, and then just like some basic shifts in consumer habits and behavior, in large part because of the pandemic. I've sort of informed some of the main picks for this year. And worth saying, these aren't buys and sells. Bloomberg Intelligence analysts won't go there, but some of these do have positive and negative connotations.
It's a global list. Pull out some of the specifics. Hot companies in the U.S. and abroad.
Okay. All right. So a couple from the U.S. That I think stand out. Roblox. So obviously Facebook, now Meta, has really planted a flag there. Roblox is a really interesting one because Roblox is already sort of a metaverse company. 50 million users, most of them young already. People are those kids are creating 3D worlds, and sales are just going to continue to expand. So while Meta wants to get there, Roblox is already there. Another one that I think.
I was going to ask, what about some unexpected companies?
Okay, so there's one that I think is worth mentioning, which Southeast Asia has this playoff happening, sort of between Grab and Sea. So we've kind of heard about all of those, but they're both companies that we want to watch because they're trying to become super apps. And so we don't really hear about them here in that same way, but there's this race there. Sea has a leg up in gaming, but while Grab is more of a ride-hailing giant. But both of those companies are going to be looking to encroach on each other's turfs and go places that neither of them have gone. So they're both publicly traded in the U.S. already. It remains this breakout moment for them as we sort of round the corners of the pandemic. Another one that I like, this Japanese motor company called Natick. I personally, before this, I had not really dug into that company, but as the electric vehicle revolution happens, it's something like little motors like this, and they have this e-axle system that is going to be used across companies, and it's little motors like that are going to be, the components that build the future.
Fascinating. Well, that is our big take for the day, looking at some international companies to watch there, and you can catch it in the upcoming edition of Bloomberg Business Week. Our Bloomberg Business Week editor, Joel Weber, thank you for sharing that with us. And that does it for this edition of Bloomberg Technology. Make sure you tune in tomorrow when we will be joined by Carla Harris, Vice Chair and Managing Director at Morgan Stanley. Also Glassdoor's Senior Economist Daniel Zhao and Steve Wesley of the Wesley Group. Big show. I'm Emily Chang in San Francisco. This is Bloomberg.